What is happening in the market right now looks irrational. If you only look at the headlines, but if you understand how cycles work, it is not irrational at all. Markets can rise while people feel terrible. Asset prices can move toward new highs while households feel squeezed. Bitcoin can rebound while inflation fears return. Housing can freeze in some regions and stay firm in others. The Federal Reserve can refuse to cut rates and still the stock market can climb. That is not because the system is simple, it is because the system is made of different parts moving at different speeds. Most people look at one piece and think they understand the whole machine. They look at the Fed or oil or unemployment, or a stock chart or the price of Bitcoin or the housing market. Then they make a decision based on one signal. That is a dangerous way to operate. When I look at a moment like this, I do not ask, what is the story? I ask, what are the forces? I ask, which forces are inflationary? Which forces are deflationary? Which forces are deflationary? Which forces support asset prices? Which forces hurt consumers? Which forces influence the Federal Reserve? And which forces are already being discounted by the market before ordinary people feel them? Right now, those forces are pulling against each other in a way that confuses almost everyone. The stock market has staged one of the strongest rebounds in years. The major indexes are back near all-time highs. Bitcoin has rallied. Home sales are showing pockets of life. Risk assets are behaving as if a new liquidity wave has already begun. But at the same time, the Federal Reserve has made it clear that rate cuts are not coming easily. Inflation is still a problem. Oil prices have risen sharply. Consumers are frustrated. Mortgage affordability remains painful, and the average person does not feel rich, even if the index on television says wealth is being created. That conflict is the story. And if you do not understand it, you can easily do the exact wrong thing at the exact wrong time. One of the biggest mistakes investors make is believing that markets and the economy are the same thing. They are connected, but they are not the same. The economy is what people are living through today. The market is constantly trying to discount what the economy may look like tomorrow. That is why you can have a market rally when consumer sentiment is awful. Wall Street is looking forward. Main Street is feeling the present. When grocery bills are high, oil is expensive, jobs feel uncertain, and mortgage payments are painful, consumers say things are bad. They are not lying. That is their reality. But markets may look at the same data and say, if things are this bad, policy will eventually loosen, earnings may recover, liquidity may return, and assets may be worth more later. That is why the market can move up while people feel worse. It does not mean the market is right. It means the market is operating on a different time horizon. That distinction matters, because people who invest only based on how they feel today usually sell when the emotional pain is highest. And historically, emotional pain often creates better prices, not worse ones. The bottom rarely feels safe. The bottom usually feels like confusion, anger, fear, and exhaustion. That is why markets punish people who wait for clarity. By the time clarity arrives, the price often already moved. We have just seen that dynamic again. The market fell hard enough to scare people. Then, in a short period, it rallied with unusual force. People who sold because they wanted to wait until the news improved missed the move. That happens over and over in cycles because the market is not waiting for your confidence. It moves before your confidence returns. This is one of the most important investing principles I know. You cannot consistently time the turn. You can build a system that survives the turn. That is very different. Now let us look at the first force driving the current environment, because it sits underneath almost everything else: oil. Most people treat oil as something that matters only when they fill up their car. That is a mistake. Oil is a hidden input in almost every part of the economy. It moves goods, it powers transport, it affects shipping, it affects food, it affects fertilizer, it affects plastics, it affects packaging, it affects airlines, it affects manufacturing. When oil rises, it does not stay isolated. It moves through the system. A higher oil price becomes a higher transportation cost. A higher transportation cost becomes a higher price on shelves. Higher prices squeeze household budgets. Squeezed households spend differently. Businesses see margin pressure. The Federal Reserve sees inflation pressure. Bond markets adjust. Mortgage rates adjust. Stocks reprice. That is the chain. When oil moves from much lower levels to much higher levels, the inflationary effect is not theoretical. It shows up in the numbers. It shows up with a lag. It often appears after people have already convinced themselves inflation is solved. That is what makes this environment so delicate. The market wants rate cuts. Investors want cheaper money. Consumers want lower mortgage rates. Businesses want relief. The government wants lower interest costs. But oil is pushing in the other direction. The Federal Reserve cannot simply ignore that. If the Fed cuts rates while inflation pressures are reaccelerating, it risks feeding the very problem it is supposed to control. If the Fed does not cut, it keeps pressure on borrowers, housing, small businesses, and parts of the economy that already feel stressed. That is the dilemma. Markets often behave as if the Fed is a machine that will always rescue asset prices. But the Fed is constrained. It has to respond to inflation, labor conditions, financial stability, and political pressure all at once. When inflation is low and unemployment is high, the playbook is easy. Cut rates, add liquidity, support the system when inflation is sticky and growth is fragile, the playbook becomes much harder. That is where we are. The Fed has not canceled the possibility of future easing forever. Nothing works that way, but it has effectively made clear that easy rate cuts are off the table until inflation gives it permission. That matters for every asset class. And yet, the market rallied anyway. Why? Because asset markets do not move on one variable. They move on expectations, positioning, liquidity, earnings, sentiment, and probabilities. Sometimes the market rallies because the news is good. Sometimes it rallies because the bad news is already priced in. Sometimes it rallies because people are underpositioned. Sometimes it rallies because everyone who wanted to sell already sold. That is why it is so dangerous to say the Fed did not cut, therefore stocks must fall. Markets are not that mechanical. They are complex systems. And in complex systems, the same event can produce different outcomes depending on positioning. If everyone already expects bad news and bad news arrives, the market may rise. If everyone expects perfection and decent news arrives, the market may fall. What matters is not just the fact. What matters is the fact versus expectation. Right now, expectations had become very fragile. A lot of investors were scared. A lot of people were waiting. A lot of people thought the market had to fall further before it could recover. Then the market did what markets often do. It moved without asking for permission. This is why I tell people to think in systems instead of predictions. If your plan depends on knowing what happens next week, you do not have a plan. You have a guess. If your plan can survive being wrong about next week, then you are building something more robust. The current rally may continue. It may become what people call a melt-up, where asset prices rise faster and farther than most people expect because liquidity, positioning, and momentum feed on themselves. Or it may fail if inflation forces rates higher, earnings disappoint, or some shock hits the system. Both outcomes are possible. The job of an investor is not to become emotionally attached to one outcome. The job is to hold a balanced, durable system that works across a range of outcomes. That brings me to consumer sentiment. There is something very important happening here. Consumer sentiment is extremely weak while asset prices are strong. That tells you the economy is not being experienced evenly. People who own assets feel the market recovery. People who rely mostly on wages feel inflation, rent, groceries, gas, and debt service. This is a classic feature of late cycle environments. Asset owners benefit from financial market strength. Non-asset owners feel the cost of living, the gap widens. Anger rises. People look for explanations. Politicians offer simple narratives. But the deeper issue is structural. When liquidity moves into assets, people who own assets get richer. When inflation moves into necessities, people who live paycheck to paycheck get poorer. Those two things can happen at the same time. That is why the market can melt up while society feels stressed. It is not a contradiction. It is a distribution problem. If you are an investor, you need to understand that dynamic without becoming cynical or emotional. The system rewards asset ownership over long periods. That does not mean every asset is good. It does not mean every price is attractive. It means that over time, owning productive assets has usually been better than sitting only in cash and waiting for the world to become comfortable. Comfort is expensive. Waiting for comfort usually means buying later after the opportunity has already been repriced. This does not mean you should chase every rally. Chasing is not a system. Chasing is emotion in a different costume. The better principle is to decide what you want to own, what allocation you can emotionally survive, and what amount you can add consistently through volatility. Because the greatest returns usually do not come from perfect timing. They come from surviving long enough, staying invested enough, and having the discipline not to abandon the process at the bottom. Now let us talk about Bitcoin because it has become another example of the same psychological pattern. Bitcoin fell hard enough to make people doubt it again. That is what volatile assets do when they fall. People say the story is dead. When they rise, people say the story is unstoppable. Neither extreme is usually the right way to think. Bitcoin is not a normal asset. It is volatile. It can move against you quickly. It can fall 30%, 40%, or 50% and still be within its historical behavior. That makes it dangerous for people who cannot size it properly. But it is also true that institutional interest has grown. Bitcoin ETFs have changed access. Large financial institutions have moved closer to the asset. Some investors view it as a hedge against debt, currency debasement, and distrust in traditional systems. Those forces are real. So is the volatility. The right question is not, will Bitcoin go up next month? The right question is, what role should a highly volatile asymmetric asset play in a diversified portfolio, if any? For some people, the answer is none. That is fine. If you cannot tolerate the drawdowns, you should not own it. For others, a small allocation can make sense as a long-term option on a new monetary and technological network. But the key phrase is small allocation. The amount must be low enough that a severe drawdown does not force bad behavior. Because with assets like Bitcoin, behavior is the whole game. When everyone says it is dead, that is often when prices are more attractive. When everyone says it is going to the moon, that is often when risk is higher. Human emotion moves in cycles. Bitcoin simply makes those cycles louder. The same principle applies to stocks. When fear is extreme, expected returns often improve. When confidence is extreme, expected returns often weaken. But most people do the reverse. They buy when they feel safe and sell when they feel pain. That is why the investor's biggest edge is not information. It is temperament. Now let us look at housing, because housing is telling a very different story from stocks. Nationally, home prices may appear stable, but national averages hide local realities. Some markets are softening, some markets are flat. Some northern and more affordable regions may still show strength. Parts of the Sunday Belt that ran up aggressively may face pressure. High-cost Western markets may stagnate. Inventory migration, insurance costs, affordability, and local employment all matter. Housing is not one market. It is thousands of local markets. The common constraint across almost all of them is mortgage rates. Higher mortgage rates change affordability immediately. A buyer who could afford a certain monthly payment at 3% cannot afford the same house at 7%. The math does not care about optimism unless incomes rise enough or prices fall enough. Affordability remains strained. This creates a frozen market. Sellers do not want to sell because many of them have low-rate mortgages. Buyers do not want to buy because monthly payments are too high. Inventory rises in some regions. Sellers start negotiating. Buyers become patient. Transactions slow. That is not a crash everywhere. It is a repricing of affordability. People keep asking whether housing will go up or down. That is too simple. The better question is, which markets have too much supply? Which markets have unaffordable prices relative to local income? Which markets have insurance or tax pressure? And which markets still have structural demand? The answer is not the same everywhere. For investors, the lesson is to avoid using national headlines to make local decisions. A house is not an index fund. A house exists in a neighborhood. Its value depends on local income, local supply, local jobs, local schools, local taxes, local insurance, and local buyer psychology. And yet mortgage rates remain the central force. If rates fall meaningfully, affordability improves. But if they fall only slightly, the relief may not be enough to change the market. A move from very high rates to moderately high rates helps, but it does not recreate the world of 2021. People hoping for a sudden return to ultra cheap money may be disappointed. That is one of the larger lessons of this cycle. The past few years were not normal. The zero-rate world trained people to believe money should always be cheap. But cheap money changes behavior. It inflates asset prices, it encourages leverage, it makes people feel wealthier than they are. And when the cost of money normalizes, the system has to adjust. That adjustment takes time. It does not always happen as a crash. Sometimes it happens as stagnation. Prices move sideways while incomes slowly catch up. Sellers wait, buyers wait, transactions fall, the market digests the excess over years. That may be the more probable outcome in many housing markets. Now let us return to the Federal Reserve. A Fed meeting is not important because of one sentence. It is important because it reveals the reaction function. A reaction function means the rule, explicit or implicit, that tells you how policymakers are likely to respond to changing conditions. If inflation rises, what will they do? If unemployment rises, what will they do? If markets fall sharply, what will they do? If oil prices spike, what will they do? If the banking system shows stress, what will they do? The Fed's reaction function is more important than any single forecast. Right now, the reaction function is constrained by inflation. The Fed wants to help if the economy weakens, but it does not want to reignite inflation. It wants financial stability, but it does not want markets to assume there is always a free rescue. It wants to lower rates eventually, but it needs data that gives it cover. That is why rate cuts are difficult, and that is why markets are so sensitive to every inflation number, oil movement, and labor report. The source of uncertainty is not that the Fed has no tools. The source of uncertainty is that each tool has a cost cut too soon, and inflation can come back, hold too long, and growth can weaken, print too much, and assets can inflate while currency purchasing power falls, tighten too much, and debt markets can break. There is no painless path. That is the reality investors must accept. The coming leadership transition at the Fed adds another layer. A new chair can shift tone, a new chair can emphasize different risks, a new chair can change market expectations, but no chair is a king. A Fed chair operates within a committee, within data, within politics. Within credibility constraints and within the bond market, markets often over-personalize institutions. They act as if one person controls everything. That is rarely true. Systems are bigger than individuals. A new Fed chair may influence the direction of policy, but the deeper forces remain. Debt remains. Inflation pressure remains. Oil pressure remains. Housing affordability remains. Asset valuations remain. Consumer stress remains. The chair matters, but the machine matters more. This is why I do not build an investment strategy around one person's speech. I build it around principles. The first principle is that nobody knows the short term. The second principle is that money and credit drive cycles. The third principle is that inflation and interest rates determine the pressure on assets. The fourth principle is that diversification protects you from being wrong. The fifth principle is that consistent behavior matters more than clever predictions. If you understand those principles, you can operate in confusing environments without being pulled around by every headline. Let us take the current situation. Oil is inflationary. Rate cuts are less likely in the near term. Stocks are rallying. Consumer sentiment is weak. Bitcoin is rebounding. Housing is soft in some places. A Fed leadership change is coming. The national debt remains high. Investors are nervous, yet underinvested people are afraid of missing out. That is a complicated mix. A person who needs certainty will freeze. A person who needs excitement will chase. A person with principles will rebalance, size risk, and keep moving. That is the difference I have learned over many cycles, that the most dangerous phrase in investing is, "This time I know." People say, "I know the market will crash," or they say, "I know the melt-up has begun," or they say, "I know Bitcoin is dead," or they say, "I know housing will recover." The truth is usually more probabilistic. You may have a view, but you must also respect the opposite outcome. The market can do what you think for reasons you did not expect. It can do the opposite for reasons nobody saw. A tweet, a war headline, an oil shock, a credit event, or a policy reversal can change the next few weeks instantly. That is why short-term certainty is so expensive. The better strategy is to choose an allocation you can hold through a 30 to 50% drawdown without panicking. That is not a pleasant sentence, but it is a realistic one. If your portfolio is built so aggressively that a normal bear market forces you to sell, it is not an investment strategy, it is a behavioral trap. People underestimate how much of investing is emotional endurance. The math says buy good assets and hold them. The mind says sell when pain becomes unbearable. The system must be built to protect you from your mind. That is why recurring investment can be powerful. When you decide in advance to invest a certain amount on a regular schedule, you reduce the role of emotion. You buy when things feel good, you buy when things feel terrible, you accept that you will never buy the exact bottom and never sell the exact top. You participate in the long-term productivity of the system instead of constantly trying to outguess it. That does not mean you ignore valuations. It does not mean you ignore risk. It means you stop pretending that your feelings are a forecasting tool. Most people do not lose because they lack information. They lose because they cannot stick with a sensible plan. They buy too much when they are excited. They sell too much when they are afraid. They listen to people who sound certain because certainty feels comforting, but comfort is not truth. The market has a way of making people feel smartest right before it humbles them. When everyone felt safe, risk was rising. When everyone felt frightened, opportunity was improving. That pattern repeats because human nature repeats. Now, what should a thoughtful investor do in an environment like this? First, accept that inflation is not gone. It may cool. It may reaccelerate. It may move in waves. Oil can make that process more unstable. So do not build a plan that only works if rates fall quickly and inflation disappears. Second, accept that assets can continue rising even when the economy feels bad. Do not confuse your personal frustration with market direction. They can diverge for longer than you think. Third, avoid excessive cash if your time horizon is long, but keep enough liquidity so you do not become a forced seller. Cash is not evil. Cash is optionality. But too much cash for too long becomes a slow loss of purchasing power. Fourth, understand what you own. A broad stock index is not magic, but it gives you exposure to productive companies. Bitcoin is not a guaranteed hedge, but it may offer asymmetric exposure for those who can handle volatility. Real estate is not always safe, but local quality and leverage terms matter. Bonds can stabilize portfolios, but duration risk matters. Every asset has a role, and every asset has a weakness. Fifth, do not let headlines determine your allocation. Headlines are designed to capture attention. Portfolios are built to capture compounding. Those are different games. The media will tell you the Fed canceled cuts. Then it will tell you cuts are coming back. It will tell you inflation is solved. Then it will tell you inflation is back. It will tell you Bitcoin is dead. Then it will tell you Bitcoin is unstoppable. It will tell you housing is crashing. Then it will tell you housing is unaffordable again. If you react to every cycle of narrative, you will be the liquidity for people with stronger systems. The market rewards the patient by taking money from the impulsive. That is not moral, it is mechanical. At the end of the day, the current environment is not a simple bullish story or a simple bearish story. It is a late cycle policy, constrained liquidity, sensitive environment with inflation risk and strong asset momentum. That means there will be opportunities, but also traps. The opportunity is that markets can climb a wall of worry if earnings hold up, if liquidity improves, if investors remain underpositioned, and if the Fed eventually gets room to ease. Risk assets can continue to rise more than cautious people expect. The trap is that oil and inflation can keep policy tight, valuations can become stretched, and people who chase late can get hurt if the cycle turns. Both things can be true. The correct response is not panic. The correct response is balance. Balance is not exciting. It does not get clicks. It does not make you feel like a genius. But balance is how you survive the unknown long enough to benefit from the known. And what is known, productive assets tend to compound over long periods. Currencies tend to lose purchasing power over long periods. Human beings tend to overreact in both directions. Policymakers tend to respond when pain becomes systemic. Markets tend to move before the average person feels better, and the future is always uncertain. Those are principles worth building around. So when I look at this market, I do not say, I know exactly what happens next. I say, I know the range of outcomes is wide. I know inflation matters. I know oil matters. I know the Fed is constrained. I know consumer pain is real. I know asset momentum is powerful. I know timing is hard. I know abandoning a long-term plan because of a headline is usually a mistake. That is enough. You do not need perfect knowledge to make good decisions. You need a good process. A good process says keep investing in a disciplined way. Keep your allocation aligned with your risk tolerance. Keep enough cash to avoid forced selling. Keep owning productive assets. Keep your speculative exposure size correctly. Keep questioning your assumptions. Keep learning from what the market is actually doing, not what you want it to do. The people who sold because they wanted certainty missed the rally. The people who waited for Bitcoin to feel safe missed the rebound. The people who assume housing is one national story will misunderstand local reality. The people who think the Fed controls everything will miss the importance of oil, earnings, sentiment, and positioning. The people who believe they can perfectly predict the next move will eventually be humbled. I have seen that movie many times. This is why the simplest strategy is often the hardest to follow. Decide how much you will invest, decide what you will own, decide how much volatility you can handle. Then stay consistent through the cycle. Do that when the Fed sounds hawkish, do it when the Fed sounds dovish, do it when oil rises, do it when oil falls, do it when consumer sentiment is low. Do it when everyone feels rich, do it when Bitcoin is hated, do it when Bitcoin is celebrated, do it when housing is frozen, do it when housing is booming. That is not because the same asset is always cheap, it is because the process protects you from turning every headline into a life-changing mistake. If this is the beginning of a melt up, you participate. If it is a false rally before another decline, you survive and keep buying at better prices. If inflation stays sticky, you are not overdependent on rate cuts. If rates eventually fall, your assets can benefit. That is what a robust plan does. It does not require one perfect prediction. It gives you a way to live with uncertainty. And uncertainty is not going away. There will always be another Fed meeting, another oil shock, another inflation report, another election, another war headline, another housing forecast, another Bitcoin panic, another market rally that feels impossible. If you wait for all of those things to resolve, you will wait forever. The world does not give investors a clean, all-clear signal. The world gives you cycles, probabilities, and consequences. So the question is not whether this market is unbelievable. The question is whether your process is strong enough to participate without being destroyed by your own emotions. That is the real test. Not whether Jerome Powell cuts this month. Not whether the next chair says the right thing. Not whether Bitcoin goes up another 13%. Not whether housing prices rise 0% or 4%. Those things matter, but they are not the foundation. The foundation is whether you understand cause and effect. Oil affects inflation. Inflation affects rates. Rates affect discount rates. Discount rates affect asset prices. Sentiment affects positioning. Positioning affects the speed of moves. Liquidity affects everything. Human behavior exaggerates every cycle. When you see those links, the chaos becomes less confusing. It does not become predictable, but it becomes understandable. And understanding is enough to prevent panic. The market may continue melting up. It may correct violently. It may do both in sequence just to confuse everyone. But if you own a thoughtful mix of productive assets, maintain liquidity, size risk intelligently, and keep investing through noise, you do not need the next headline to save you. You have a system, and in the long run, systems beat reactions. That is what I want you to take from this moment. Do not worship the rally. Do not fear the rally. Do not chase it blindly. Do not fight it emotionally. Understand it as part of a cycle in which inflation, policy, sentiment, liquidity, and human psychology are all interacting. Then act like a long-term investor. Stay humble. Stay diversified. Stay consistent. And remember that the goal is not to be right about every market move. The goal is to be positioned so that one wrong move does not take you out of the game.